Good afternoon, all. Steve Parisi here with IBC Global. I hope your day is off to a fantastic start. Today, we've got a guest that I am super excited about. I've known him since 2021, but it feels like it's been my entire life. We have Brock Bales on today. He is partners with someone you may know, Elizabeth Morgan, who we've had many podcasts with over the years. And we're going to have fun today talking about business and tax planning and things that I think you'll enjoy a lot. Brock, how are you, my friend?
I'm doing well, Steve. Thanks for having me.
Thanks for doing this. I think this would be a lot of fun, and I think people are going to enjoy it. So, there's a lot I want to ask you, just in terms of what you do, but what you've done for me, for business owners. A lot of our clients absolutely love working with you, Elizabeth, and your team, which maybe we'll touch on. But since this is the first time you and I have done a podcast, I do want to ask just a little bit about you so folks can get familiar with you. So instead of asking about your background first, what kind of lawyer are you, or what area do you practice in?
Well, that's a fun question, and it's one that we could talk a lot about. Essentially what we do is we serve as strategic advisory counsel to entrepreneurs and family offices, which means we deal with a lot of different issues on a daily basis. So if you're working with clients from, progressing on the road from 5 million to 5 billion, there's just so many legal issues that they come across. And so depending on the day, I'm structuring an international transaction, practicing as an M&A attorney. The next day, we're practicing as estate planning attorneys. The next day, we're in family law. Other times, we're practicing as, tax advisors or asset protection lawyers, or working with insurance agents like you. And it's a really broad spectrum of things that you have to be an expert in to be able to sort of be that counsel to
Yeah.
family offices. But I like to just say I read and write and talk all day. That's basically what it boils down to.
That works. You're good at that too, particularly communicating these complex things in tax and business law in English, at least where I get it, which means a lot because
Mostly in English, hopefully.
mostly in English. No, I'm with you there. Well, what I wanted to focus on today is just kind of high level, particularly on the business side of things, because you're good in all those areas you just mentioned. But if you were to pick the area you like the most and call it your wheelhouse, would that be more on the business planning side of things as opposed to personal estate planning?
The areas of law that I really, really enjoy, and we touch on I love building things.
Yeah.
Like the idea of constructing a business with all of its various structures, or designing a transaction, putting that together, setting up trusts and all. I think where I thrive and where I get the most satisfaction is designing structures that work really well for clients. And that could be, it can just look so many different ways. But normally I'm more on the tax M&A structuring side of the transaction.
Got it. Got it. Thank you for that. So let's talk about different types of entities. And I'm going to talk as if I am a new business owner, young Steve from many years ago, thinking, all right, I probably should not just conduct business in my own name. I should probably set up some type of entity to receive money because I know that much, that that's smart, but that's about it. And then I learn about LLCs, S corps, C corps, all this other stuff, and I really have no clue other than what my friend or maybe my papa says, this is the one you should do. And I say, okay. That's usually, I feel like how most business owners start, where if you do a little bit more homework beforehand, it'll probably be to your benefit. So what I wanted to start with is just going through LLCs, S corps, and C corps, and at a high level, just defining what they are and who that might be ideal for. And we can start with an LLC if you'd like.
I can certainly start with an LLC, but I think it helps if we just step back to what is a business entity.
Yeah.
A business entity is essentially a fake person that the government allowed you to create. It's an avatar. It is allowed to contract. It can enter in transactions in its own name. And so, Steve, you could start a business tomorrow in your own name, right? You can just go open up a bank account, start transacting in your own name, but you would be completely exposed to the liabilities created by that business. And you'd also be by yourself. So the first form of entity was a partnership. It was just basically you and I getting together and transacting to do business. And that works well because you can get a bunch of people together, all working together, all sharing in the profits of the business. But that had a downside. The downside was is if you and I are in a partnership and I do something wrong, you're going to go down with me. That's the problem with a partnership. Also, the sort of the organizational structure of that didn't lend itself to more complicated businesses that needed lots of executives, et cetera, or some sort of hierarchy or org structure. And so then we came up with the idea of a corporation, right? Where you issue shares to people who hold the equity and you structure the organizational hierarchy and executive team. Well, and that worked well, but it was sort of complicated, and there's two layers of tax. So then people came up with the idea of an LLC, which is like this chimera. It looks like a corp, it walks like a corp, but then sometimes it looks like a partnership and walks like a partnership. And the US really led the charge there because we came up with an entity that could be all these different things to all different sorts of people. And it's basically just governed by a contract. So why most people talk about LLCs is because we get to sit on this history of, evolution and perfecting things. And we came up with the LLC, and it's beautifully flexible. So when we talk about S corp, partnership, disregarded entity, C corp, now a lot of times that gets conflated with entity type when really it has to do with its tax election. So when we talk about what entity should we form, the types of entities are sole prop, different types of partnerships, corporation, and an LLC. And there's other kinds that are just, those are the main ones. Like we could talk about other kinds. And then what we talk about is the election that the entity makes to be taxed. So the entity that we like because of its flexibility is an LLC. There are reasons why you wouldn't form one, but most of the time you can get to where you're wanting to go with an LLC. There's also types of LLCs, like there's professional limited liability companies, which have special protection. But typically clients are looking at forming an LLC for their business or deploying that LLC within a broader structure with a specific tax election. Is that helpful, the kind of bifurcation between form of entity versus the election it makes?
It is, yeah. All stuff that I had no clue about and still need to try to absorb to figure out like the the purpose of setting it up and the reasons why. Let me ask this so we can kind of use myself as a use case here. So if I start my insurance business years ago, I do everything in my own name. Let's say initially I have a partner where we just split everything 50-50. And it's just 50% of the business goes to him, 50% goes to me, to Steve, and the other guy's name is Joe, right? Whoever it might be. So we do that for a while. And that, as you mentioned, has liability in case he does anything wrong, I do anything wrong, or if one stops working and the agreement is they should still get 50%, like that causes issues, correct? And that's tough to do anything legally. Correct me if I'm wrong. Does that just create
Yeah,
a,
a
yeah,
partnership is sort of akin to a marriage with
yeah,
respect to the business.
yeah,
So you are bonded at the hip. If
yep,
something happens in a general partnership scenario, you're both completely exposed to the creditors of the business, and all of your assets are titled in your name.
right,
And so are the business assets are essentially titled in the name of the GP, which is as if you held them. So
right,
that's why the LLC is attractive or a limited partnership, for example. The idea is to give limited liability to the equity owners of the business, which the LLC provides because it
Yeah.
is, as its name would suggest, a limited liability company.
Hmm.
So you bifurcate ownership in your individual name versus ownership inside of the entity. And then you also sort of dig a moat around the business where your liabilities as an individual don't come into the business. And the business liabilities similarly can't exit the business. We call that a veil. So that's where you get veil piercing liability. If you disregard the entity structure, it's as if it didn't exist. So the court can pierce the veil. But the idea with any business is to make some good fences around your relationships. If you and Joe have been friends forever, there can be this concept of, well, let's just start working together.
Yeah.
And you accidentally form a general partnership and you accidentally expose yourself to all of his liabilities. The better thing to do would be to think about what is the nature of the business? What is the relationship I want to have with Joe? What things could go wrong? What are the worst case scenarios? We stop talking to each other. Joe gets a divorce. You die. What you become incapacitated. One of you loses your insurance license.
Hmm.
And you construct that framework. And the beauty of the LLC is it can pair with that framework in almost every circumstance.
Yeah.
And it's just a contract. So you guys can come up with what contract makes the most sense to you with buy sell provisions or how you
Yeah.
want to allocate liability, how you want to designate control.
Got it. So thanks for mentioning that piece because that is what I think most people don't think about. They just think things are going to work out and be just like they are in day one. So if I'm working with Joe, we're 50-50 partners, things are good right now. We consult with you and we say, hey, we want to set up an LLC because we know we should. That's the smart thing to do. We've done some research. Is that something that you'll often speak with clients about? Like you would bring that up if we're new clients with you to say, here are some things that we would recommend putting into an agreement or a contract between the two of you to protect both of you. Is that something that you guys help your clients think through?
Oh, certainly. Yeah. And
Yeah.
there's kind of like what I would say the initial phase. Like if I just met you and Joe, we don't sell products, we don't sell structures. What we like to do is form a relationship.
Hmm.
Because, Steve, right now, if you came to me and you said, I wanted to do a deal with Joe, and we've known you since 2021, I already know what's important to you.
Hmm.
I already know the things that you've wrestled with in the past. I know what feels like friction to you. I know what you like and dislike, down to even personal things.
Yeah.
And I can very quickly, almost intuitively, come up with a structure, the right entity, the right tax election, and write that contract, which is essentially an operating agreement
Yeah.
for you and Joe. If I just met you and you just came, what most lawyers do is they sell a specific product and say, this shoe fits most people, this hat fits most people. Here you go. Here's your documents. You pay a relatively low fee, or you ask an AI agent or something like LegalZoom or to draft your documents. And essentially, what they're giving you is just a standard form template that works for most people.
Yeah.
And a lot of times it's halfway decent, but other times you end up with a document that you didn't really understand, that didn't address all the concerns that you have. So what we like to do is build a relationship with the client over sort of the consultation phase where
Hmm.
we get to know you. We ask lots of questions. We see how you interact with Joe. We figure out what matters to you, what you think the dangers might be. And we also alert you to things you might not have thought about. And hopefully, at the end of that sort of initial phase, we land on something that when you try it on, it fits perfectly.
Yeah.
Like
Got it.
we've taken everything into consideration, and also we've coached you through, because we went through that process, how to actually use the thing that we gave you, which
Hmm.
can be the problem if you just generate something for a couple $100 online or whatever it is. You end up being handed a tool you don't even really know how to deploy or utilize. It is a really great tool. good to use or is a okay tool that you really, really know how to utilize, right?
Hmm.
Sometimes knowing how to utilize a less flexible tool or a less like luxurious tool or whatever you want to use the term, knowing how to use it can be almost more important than the tool itself.
Thank you for that. Speaking from experience, you have helped me a lot with that foresight and thinking through things that I might not think about on my own. So let me ask this. So let's start with the partner example. I want to talk about like when an LLC versus maybe a different entity might be a good idea, like one versus another. Let's pretend that I'm partners with Joe. We are doing 1 million per year and growing. That's heading north, and we sell cupcakes and baked goods, that type of business. We think we should set up an LLC. Would that be ideal, or should it be something else? A lot of times this is a basic question where people just don't know what to do.
So going back to the entity form, the nice thing about the LLC is it's likely going to fit with whatever business relationship you want to have with Joe. So let's use an example. If you formed a corp, you are statutorily prescribed to have a board, a president, and a various form of executives. That might feel like friction to you. You might
Yeah.
not want to form, have those people. A partnership often has what's called a general partner who exercises complete, unlimited sort of, the dictator level of control. That might also feel like friction. An LLC has this concept called a manager. Now, it can still have executives, it can still have a board, but again, it's essentially a creature of contract. So you can establish the control mechanisms that feel right to you. You can establish the buy sell provisions, like what happens on death. Do you couple that with, a sort of what happens if one person gets divorced or becomes incapacitated or whatever those provisions are, you can come up with those in the LLC. Um, so that gets you to where you want to be in terms of your relationship with Joe. Then the question becomes, how does the LLC want to be taxed?
Yeah.
So, and in the end of the 90s, 1997, the IRS released what's called the check the box regulations. So there's this section in the code 7701, which is basically the definition section of the code. And then they overlaid these regulations. So that section would define what a corp is, or what a partnership is, or what a U.S. person is, etc. And they gave regs because we had this thing called an LLC, and we're trying to figure out how is this LLC taxed? Is
Mhm.
it a partnership? Is it disregarded? Is it a corp? Is it an S corp? What is it? And they came up with these regulations which allow you to essentially check the box. So if you were to form an LLC with just you and Joe and you did nothing, you would become taxed as a partnership.
Okay.
If you formed an LLC by yourself and you did nothing, it would actually be taxed as a disregarded entity, essentially a sole proprietorship,
Okay.
which those default classifications may be right for you. They may not be right for you. So you could elect as a single member, a multi-member LLC to be taxed as a corporation, an actual per se C Corp, by filing an 8832 and checking the box to be taxed as a corp. Or you could file a 2553, which will allow you to elect to be taxed as an S Corp. So when people say form an S Corp, you don't actually form an S Corp. What you do is you form an LLC or you form an Inc., and then you file an election to be taxed as an S corporation. So with an LLC, you have your formation, how it's formed, and then you have how it's taxed. So it could be
Yeah.
disregarded, partnership, C corp, S corp. So in your concept of, so let's think about this. If you're selling, your widget that you're selling is essentially cupcakes,
Cupcakes.
right?
Yeah.
So the questions we might ask are, where are you selling the cupcakes? Are you
And
selling them in one state? Are you
one,
selling them
yeah.
internationally? Are you selling them
Um,
multinationally? What is the
yeah, I've got a store down in Houston, and then also I do ship them nationwide online as well for people that order through our online our website.
Okay, so now it's starting to get interesting. So if you're selling in multiple states and multiple countries and you have a store, the
Hmm.
things that I'm thinking of, do you own the store? Is that an asset?
I
If
don't own
so,
the building. No, I lease
you
it. Yeah,
you own the building. Okay,
I
so
don't.
now we're thinking about
Yeah,
you don't own the building or
I
you
lease it.
you
Yeah, I
lease it.
don't own
Okay.
it. Yeah.
So that's just an expense inside the business. If you own the building, we'd be thinking about how do we protect that asset?
Okay, got it.
We've already got your relationship with Joe. We're thinking about what tax classification makes the most sense. The reason why people, I'll start with this. The reason why people form S corps is because it can save you on your FICA taxes and your self-employment taxes.
Hmm.
Because if you were to receive all of your income through the K1 in your partnership, it would be all completely exposed to those taxes as if you were a sole prop. When you form an S corp, you can issue a K1, which is not subject to those taxes, but then you must pay yourself a reasonable salary
Yeah.
where those taxes are taken into account. So you can play with those numbers to get to a tax rate that's lower than if you were in a partnership. And then in a C Corp, the C Corp pays its own tax, which is a flat 21% rate right now.
Hmm.
Which, if you're keeping all the profits in the business and reinvesting them at $1 million of income, 21% looks a lot better than 30, 37, 39%, whatever the rate ends up being. And then also take into account state income taxes, etc.
Hmm.
But in the corp, you then have to dividend out the income, which is subject to another tax hit. So that's why when people say there's two layers of tax in a C corp, but the way that the current rates are right now, a partnership and a C corp gets you roughly in the same tax bracket because of the 21% plus another 20% or so on the dividend rate. They're all floating rates.
Hmm.
Um, the S
Interesting.
corp will get you much lower initially. Now, as you go out, the percentage difference, like as you hit 10 million or et cetera, at 100,000, the S Corp is very attractive. At a
Hmm.
million, you're still having savings. At 10 million, the differential's getting smaller
Yeah.
just because you're at such a when we run it through all the various tax rates, et cetera. The other question I might ask is what types of benefits you're providing to your employees and your staff.
Hmm.
Because even though the C Corp might be at a higher rate, if the level of benefit planning that you're having and the C Corp is the only entity in some case that can allow for certain types of benefits, depending on what you're doing, you can reach marginally level, relatively close levels of tax rate, ultimate effective tax rate in a
Hmm.
C Corp and an S Corp, depending on how your benefits planning is.
Yeah.
So there, it's hard to say in just $1 million entity which rate. We go to the tax conference here in Austin every year, and tax advisors will say the phrase, friends don't let friends form S Corps.
Yeah.
And that is sort of reactive to the market basically saying everyone form an S Corp. And that's because in most circumstances, if you just look at the income tax consequence, the tax rate can be lower, your effective tax rate.
Hmm.
But there are lots of restrictions to S Corps that people don't think about. They can only have 100 owners. Only certain types of trusts can own them. So it can be a huge problem in estate planning.
Hmm.
Certain types of businesses, it can be really detrimental. In your entity, what we're talking about, the S corp probably, if we did the analysis, it might come ahead on the tax consequences. However, if you're thinking of it in terms of an exit perspective, it might be that your S corp is problematic from an exit perspective. It might be that the S Corp is a problematic target, say for a foreign buyer or a
Hmm.
buyer that's taxed as a partnership or another S Corp. You'd have to restructure before you were acquired. In the C Corp, you have something which is called a QSBS treatment, qualified small business stock.
Okay.
which provides an exclusion to capital gain. So potentially, if your goal in this business was not to pull out the profits on an annual basis, but
Hmm.
to reinvest them over time and then sell, say in 5 years, it could be that the C Corp over the whole plan, given the QSBS exemption and the fact that you'd have a flat 21% tax, or
Hmm.
if you were living in California, for example, the C Corp may come out ahead. You're still an LLC, but you elected to be taxed as a C Corp.
Yeah.
So it's hard to tell because there's so many questions I could ask to
Yeah.
tease out what election makes the most sense to you. But in your scenario, there could be a number of options that could make sense. But the answers to the questions of when you're selling, how you're deploying the income, where you're sitting, are you taking in other investors?
All that stuff.
All
Yeah.
that stuff could impact the form of entity you make and the tax selection you make.
Hmm. So thanks for the wealth of knowledge, my friend. So let me walk through a little exercise with you. And I'm curious to see how you would advise this. And I'm going to say what entity, what would the taxes look like with each entity here? So we'll go back to me and Joe selling cupcakes. Our business generates $1 million per year. That's the gross income that comes in. I take 100K salary. Joe also takes 100K salary, so there's 200. It also costs us 700 grand to run the business, and that covers everything. So between our salaries, costs of everything, employees, operating, all that good stuff, that's 900 grand. And then there's 100K left over in profit. Assuming we don't do anything with that in terms of spending it, it's just sitting in the bank account right now. How does that work if it's an LLC? Very, very high level with that profit. And Joe and I own the company 50-50.
If
Yeah.
you're an LLC, the LLC will have a section in it which controls how distributions are made.
Yep.
And it'll also typically have a section that controls who gets to make decisions with respect to that $100,000 of profit and also the salaries that you're paying yourself. That can also become a sensitive topic, who gets to set whose salary. So the LLC typically has a pro rata mechanism that says that those profits would be distributed pro rata to the ownership. So if you owned it 50-50, that's 50 each. If you owned it, 70-30, that's 70-30.
Got it.
The
Okay.
answer to that question also depends on the tax election that was made. If you're a partnership, those whether or not you distribute that leftover 100,000, the members are going to be taxed. The partners will be taxed on the income
Yeah.
regardless. So that's why a lot of times the operating agreement will have a mandatory or discretionary tax distribution provision just so that the members have enough money to pay the tax that's allocable to them regardless of whether or not the money left the company.
Yeah.
Similarly, the S corp's in the same way. You will be taxed regardless of whether you distribute the profits or not. The
Hmm.
C corp's different. If you were a C corp, that 100,000 can sit in the business. It'll pay its 21% tax on the profit, and the rest of the cash sits in the business, and there's no more tax.
Yeah. But then when you pull that out eventually, you have to pay tax on that then.
When you pull it out, it's taxed as a dividend. So you
As
would
it,
look at the dividend rate that applied to you, and then you would pay the tax on. So 100,000 minus 21, distribute the remainder, and then you would apply whatever rate of tax applied to you. So you get a differential. But
okay.
in the partnership, if you got $50 each, you
Hmm.
still have to pay the taxes with respect to that. If you
Correct.
didn't get $50 each, you still have to pay the taxes with
With
respect to your allocable income.
Yeah, because I know in the early years when I knew nothing about this and didn't know you you were Elizabeth either, on when the business started to grow, like I paid myself a very, very low salary. I still prefer to keep that low. But then when there was any type of profit in the business, I have to pay tax on that as if I took it out. And initially, when I knew nothing, like, wait a minute, like if there's $300,000 of profit here, why do I have to pay taxes when I only paid myself $50,000 for the year? Now, it was set up as an S corp initially, and that was how I initially got educated as young Steve back in the day, in my mid to late 20s. But because it was an S corp, and the same thing would apply with the LLC, assuming that the tax election is what I did, and I think what most people do. When there's profit there, the owners still have to pay tax on that, and it's passed through. So as if they took that in a distribution or for income, if it were income, it's the same thing. Correct me if I'm wrong there or similar.
Yeah, essentially, there are some entities that are pass through, and there's some entities that are opaque. A corp's
Yeah.
opaque, an S corp, a partnership is a pass through. A disregarded is a not. It's almost as if the entity didn't exist. It doesn't even
Yeah.
file a return.
Hmm.
Um, and that can feel weird that I didn't take money out of the business, but I'm still allocable
It's
tax
tax.
based
Yeah.
on the income generated. But that's the nature of the tax election that was made.
Yeah.
And
Hmm.
the operating agreement will govern how those profits are allocated and how the income tax consequences are allocated among the members.
Yeah.
Um, the other thing to think about sometimes, which people can run into trouble with, is you can actually have another level of tax if your basis in your partnership or your S corp is not as great as the distribution that you took. So, for example, when you have income in your business, you're allocated tax in a partnership, but then your basis, your capital account, increases for that profit. So you can pull out that profit and not have tax.
Okay.
If you were to pull out more in a distribution than your capital account, you would pay tax on that.
Yeah.
Again, because it's greater than your capital account. You have no basis for which to pull the money out of the business. And in some cases, you have to address this in the operating agreement. Do you have to restore your capital account on liquidation or when you leave? Do you have to put more money in the business later to bring your capital account up to zero because you brought it negative based on your distribution? So sometimes when we consult with businesses that have formed S corps or that have formed partnerships, we go through the tax returns, we go through the K-1s, and we identify these potential issues with how it was historically operated.
Yeah.
And sometimes we have to, mitigate them, the adverse tax consequences created by the historical operation of the business because they didn't understand the flow through taxation, or they were taking distributions in excessive basis, or they put a loan in and that, you know, somebody contributed an asset and diluted someone else. There's so many different issues that might need to be addressed. But your point is simply if you are operating inside a flow through business,
Yeah.
the net taxable income will flow through to you.
Gotcha.
And you have to take that into account on your personal return.
Yeah, absolutely. So simple. So if it's a LLC or S corp, which is like this used to be me, there's 100K in profit and I own 100% of the business, then that 100K flows to me, gets added to my salary, and then my total taxable income for that year is my salary plus the 100K in profit because I owned 100% of the business in that specific example.
At a high level, correct, but there's
Okay.
nuance to it, right? So if you took a salary, right, that's
Yep.
wages.
Yep.
When you get your 100K salary, that's wages. When you get your 100K distribution, that's reported on a different part of your tax return, Schedule
Yeah.
E.
Okay.
So it's a different section. So it has a different tax application because there's no self-employment tax, for example, right?
Right.
So you got 200,000, I'll do my fingers, of total income,
Yes.
but the character of each portion of the income is different. So a different tax rate can apply.
Okay.
So
Yeah.
all of that eventually hits your return. And that's where the planning comes into play.
Mhm.
Sometimes you're trying to get a higher level of income, W-2 income, to play with the different deductions that are on your personal return. So sometimes you want a little bit higher wage as
Yeah.
opposed to forcing it down to the lowest reasonable wage you can.
Hmm.
And you're trying to tie those things to your personal return. So that's where the tax planning of the entity and your personal return can interact. Like some people are trying to avoid as much K1 income as possible, which is when a C corp can come
Hmm.
into play.
Got it.
So, for example, if you're a foreign non-resident alien, you likely want a C corp formed in the US because you're trying to block and trap all of that US income in that blocker co
Yeah.
rather than having it flow through to you.
Look at that.
Well, if I'm in the US, I'm okay if the income flows through to me in a lot of circumstances. And other times I'm trying to hide that income or block that income in a C corp until the time I actually want to recognize it. Let's
Hmm.
say when I'm in a lower rate bracket or something. There
Yeah.
a lot of different reasons to form it different ways. But yeah, essentially what you're saying is the 200,000 would flow through to you. I just want to clarify that the
Yeah.
character of the income can be different and therefore the income tax consequence can be different.
I gotcha. No, I appreciate the additional detail as well, as always. So, what if I had a C corp? So let's assume my salary is 100K. The C corp has 100K in profit, and then I own 100% of it. I call you up and say, Brock, I want that profit actually personally. So I take it out. That would be in the form of a dividend.
That would be a dividend.
Gotcha.
Exactly.
And how is that taxed?
Let's just assume there's a couple. So if there's earnings and profits, there's if it used to be an S corp, let's just assume it's normal dividend treatment. So you're
Yep.
just going to look at the dividend rate that applies to you.
Okay.
But there are circumstances where the tax consequence of the dividend can be different. Like if you were an S corp in the past and then you elect to be a C corp, you
Hmm.
could have some, essentially throwback tax.
I gotcha.
It-
So it was,
It's
yeah, if it was just a C corp from the beginning, then it would just be based as a dividend. How is that taxed as income though, or is it like capital gains? I'm not familiar with that. Like how it would work, if that makes sense.
it's there's so the capital gains and ordinary income have one set of rates, and then there's a dividend rate that
Oh,
would apply
okay.
to you.
Got
So
it.
it there is a scale of rates between, let's just say, 15 and 20% that you would be paying, in addition to the 21% that the corp already paid.
Corp pays. Okay. All right. So I mean, if that paid 21% and then I pay another 15% on it, and now I know that income I wouldn't be. I mean, that's 36. At the end of the day, like if somebody's really making some serious money, one entity versus the other is not really going to save them a ton of taxes.
Well, at $1 million, let's just say the $1 million was net income.
Yeah.
If I were to do sort of finger in the air napkin analysis, you're probably right under 40% tax in a C Corp, a partnership, and a sole prop. You're
Yeah.
right in that ballpark. In an S Corp, you're probably closer to 30, 32%.
Okay.
Now, there's a whole bunch of assumptions in my math there, but you can see how the S Corp will be slightly lower.
Hmm.
And because of our low corporate rates right now, the difference between a partnership and a C Corp is 1, maybe 2%. In the past, when C Corp rates were higher, it was a dramatic difference. Like if you could imagine if C Corp rates were 30% right now, the double rate of tax in the C Corp is
Would make sense.
10%
Yeah.
difference.
Yeah. Hmm.
So, but right now with the relatively low rates, we saw when that code section was when the rate changed, we saw a lot of people moving to C corps that wouldn't have in the past,
Okay.
particularly when you couple it with the QSBS capital gain
Yeah.
exclusion, because that could exclude $10 million of gain, which
That's
for for some exits could be almost all of the gain on the exit.
how, how many of your clients know any of this? Like when you initially engage with them or after you've worked with them for several years, like me, because this stuff, like I'm involved a lot with clients and taxes. I'm not a CPA, so I don't have that knowledge, but I'm around it almost every day. And like this stuff is is deep, and it's definitely stuff you want. I don't want to know it inside and out, but I want to be able to say, here's what I want to do. And then you can ask me the questions you would ask and say, all right, do this. Like, do you run into clients that know this stuff or not really? And they're just saying, tell me what to do.
It depends.
Hmm.
There's kind of a spectrum of client where some they're really great at sales, they're really great at
Yeah.
bedside manner, they're a doctor, they're an engineer, whatever it is. And some of them, they're a rancher, they're in real
Hmm.
estate development, whatever. And some people take the perspective of this isn't my lane.
Yeah.
I'm more than happy to pay someone to optimize this for me.
Hmm.
There are other folks who are going to dig into AI and articles and ask tons of
Yes.
questions of Google or Claude or whatever they're utilizing. And they'll come armed with tons of questions and basic understanding, and sometimes a very technical understanding of the tax elections they want to make and the structuring that they want to do. And in that circumstance, sometimes I'm just coaching. I'm helping correct where AI provided a hallucinated something or didn't
Yeah.
understand a nuance, and I'm just sort of coaching or advising.
Hmm.
Um, so it really depends. It's a I think it just depends on the client. So
Yeah.
sometimes there's a lot of exposure, sometimes there's very little exposure, and sometimes that's because they were intentionally educated or they were intentionally letting someone else figure that out for them. And
Yeah.
it just depends.
I gotcha. When do like expensive, like when do you see issues pop up that need to be corrected? Meaning I set up an entity that, or tax election, whatever we want to define it as, and it wasn't done right. So now we need to go back and correct things. And it's kind of a mess where it takes time, can be kind of expensive as well. Like, do you see that a lot with companies? I'd imagine you'd see it with smaller businesses, probably between the $1 and $3 million range, where they start to get to a level where they're like, okay, we know we need to be doing this. I just hired whoever before because that's who my cousin used or whatever. And then you find out, hey, like this stuff really wasn't doing done right. It can become a problem if you stay on this path. Here's what we would recommend. Do you run into that? Because I feel like that has to happen. It happened to me, and I'm like, I thought I did everything right.
So that's why we like to start engagements with consultations
Yeah.
because it could
Hmm.
be so easy to say, here's what's right for you without understanding, the entire framework of their estate, their business, all those facts. And so we do usually a deep dive. And then you were making the comment about how it was small businesses where the messes are or the friction points are. It is in huge businesses too.
Yeah.
And to structures with hundreds of entities and multiple trusts, the messes are massive. Sometimes we will have to work for months or years to unwind structures or get them to the place they need to be when they've hit this critical mass and stuff wasn't managed like they thought and money is not flowing through the structure the way that was intended, or it is flowing through the structure, it just hasn't been papered correctly.
Yeah.
um, Various landmines, S corps sitting on top of other S corps, S corps sitting inside of trusts that can't own them, or underneath foreign structures that haven't been reported correctly.
A
So
lot. Yeah.
entrepreneurs are typically really good at making money and building a business.
Hmm.
They're not necessarily really good at doing the actuarial things in the back office.
Yeah.
And that's where typically the messes are. It's just been kind of shoved into the closet. If I make enough money, it'll all go away, which sometimes that's
Yeah.
true. Other
Yeah.
times it's not true and there's a blow up. But
Hmm.
typically, if there is a business and there are people, there are some sort of mess that needs to be cleaned up, whether it's small or massive. Um, at a small scale, it's usually someone got into an S corp or papered an operating agreement and they didn't understand the implications of the election or the operating agreement they signed. And so they have a fence with their neighbor that either wasn't high enough,
Mhm.
right? It was way too low to protect them, or they were in an election that now isn't giving them the flexibility that they want. Like, for example, they started growing their business using your cupcake analogy and they didn't want to rent anymore. So they bought a piece of real estate and now that real estate is inside of an S corp and they're starting to feel friction because that S corp doesn't allow for the tax deductions that they want, and they can't get they can't get the building out of the S corp because that would require them to liquidate the S corp potentially, and that's going to create tax. And
Mhm.
so sometimes they grew so quickly that assets are in the wrong spot and cash flows in the wrong spot. And so you're trying to tease those issues out and figure out how you restructure in a way that gets them to where they need to be without
Yeah,
creating an adverse tax consequence.
got it.
So we are
Eh,
constantly restructuring businesses, redocumenting operating agreements.
Yeah, I mean, I feel like the best thing because I have not experienced the massive, at scale size you mentioned with the foreign trusts and everything. I have experienced it to a small degree where I say, this is how I've always done things, or hey, we've got this expense, just put it in the business card. Like it's a business expense, but it was done, the expense was a different LLC. And then I get an email from you and you guys like, no, you shouldn't do that. Use this card. I'm like, I don't know, I'm just paying it, right? That's usually what I do. But the thing is, like with all that, when you have to unravel it and it's a mess, I feel like if you can start it early, and especially as you get bigger and bigger, business owners like don't want to have to keep track of all of it because it's a lot. Like it is a lot of information to know what to do, and tax laws and all this stuff changes all the time. Like, is it ideal to either have you or someone like you, or maybe they've got an attorney doing that, working with them with along the way, month by month, or maybe even with their CPA to make sure that things are done correctly. Because when it's done wrong and you have to fix it, like that's where it's going to eat up your time. Like for me, where now I have to get back in involved again and figure out what happened, what did I do, what did we do wrong, how do we not do it again? Whereas if we can just say, okay, tell us exactly what we should do. And if it's a tax question, can we just connect you with the CPA? We've done that. And it saved me a ton of time, which ultimately allows us to earn more money, which is the name of the game with business. So I feel like that's the best thing to do. Like, what would be your ideal scenario where you could say, do this company in terms of the instructions, or put us in touch with your CPA so we can help you be as efficient as possible?
As a lawyer, I would
Yeah.
say always involve a lawyer.
Yeah.
But I'm sensitive to the fact that some businesses start off small and
And
you're trying to allocate what little cash you have,
yeah.
and cash is king, and that's you only have so much. And so staring at the face of a very expensive lawyer is not ideal to you, as
Hmm.
opposed to just getting a business up and running that's profitable, etc. And we've had one client said on a podcast at one time, he just said, you don't have enough revenue for that. And so I'm sensitive to that sometimes the best possible planning that you could receive is too expensive for the size of your business at that time,
Yeah.
right? So there is a point where everything's a cost benefit analysis.
Yeah.
There's a point that the business becomes so valuable that having the right infrastructure in place, if this goes wrong, starts to become really, really important as opposed to the dollars that you have to spend on an attorney to help you figure out some things and paper things correctly.
I gotcha.
So it's hard to say when the best point for someone to have to hire an attorney or to hire a good CPA or whatever, a business coach even. There's so many different advisors out in the marketplace, and I think that that's a cost benefit analysis for the entrepreneur to figure out when the best time for them is. Definitely be really thoughtful when you're making tax elections, because once you make an election, you are in that election, and typically there's a tax consequence to get out of it, unless I do a tax-free reorg or something, but that can be quite costly.
Okay.
So be really thoughtful about that. Also, really thoughtful about where you form your entity, what
Yeah.
contract do you have with your partners or your shareholders or members, whatever? What relationship do we have? Have we defined that well? Have we defined the control mechanisms? There are a lot of times where I've seen clients where they form a 50-50 LLC, but they name one of the people the only manager.
Hmm.
And they end up in a scenario where that person gets to play, God in the sandbox. And the 50-50, the 150% owner that isn't a manager is stuck just in the business with whatever decisions that person makes when the relationship goes sideways.
Got it.
So having the proper control mechanisms can become really important. Same thing with misconduct. Let's say one person is stealing from the business or engages in some form of harassment or whatever. Do you have mechanisms in place to remove them?
Hmm.
So if you feel comfortable enough at the early stages of your business to set those pieces in place, with the understanding that once we have enough revenue to pay for better counsel, you will go to that. I think that that's probably fine in your
Yeah.
cost benefit analysis. What I think typically happens is you go past that point and you grow into the millions and millions of dollars of revenue, and you never go back and visit these things.
That's the problem.
That's
Yeah.
when the real problems start to occur because the dollars involved are massive. The tax consequences are massive. What's at stake becomes huge. It could become most of the value of your estate.
Hmm.
And you've never taken the time to hit time out real quick. Let's get this all sorted properly. And sometimes you even identify friction points you didn't even know you were dealing with.
Yeah, like that happened on a much smaller scale with us years ago. Like we had an outside bookkeeper. It was like 500 or 600 bucks a month that we used forever. I'm like, all right, it works with our accountants. Then when we went through a merger and acquisition deal with our private equity partners, which you helped us with, like our books were a bit of a mess, which you and our accountants discovered. I'm like, what? They book everything. I don't know. Like this is good. And it took a lot of time and it also wasn't cheap to unravel and correct that. Thankfully, they're perfect moving forward now, which I'm happy about. But like that was something to hit on your point. Like I had no clue. Like I just figured bookkeeping is just someone who looks at all your stuff in terms of money coming in, money going out, books it, like that's it. But it wasn't that simple as I learned. Not as you grow at least, and you've got different entities, yeah, and you have to account for everything correctly.
When you go from one to multiple entities, I mean,
Yeah,
even one entity can be complicated just because people will often run business expenses through a personal account by
right.
accident or sometimes intentionally. I could talk about bookkeeping all day. And part of that is because you could put an LLC in place thinking it provided a level of asset protection, liability protection, whatever. And if you don't respect that entity's formalities,
Yeah.
it's as if the entity wasn't even formed. The
Yeah.
court could disregard the form, pierce the veil, whatever. Um, Having that good back office, making sure that the cash flows flowing through the right accounts, being paid with the right cards, expenses are coming out of the right entities. You're keeping an income statement, you're keeping a balance sheet, you're keeping a cash flow statement, all vital. And the more entities you have and the more complicated your structure, the more vital it is. And if you have a good bookkeeper, a lot of times the bookkeeper is good, but
Hmm.
they may need to be coached. It's
Yeah.
sort of like the architect explaining to the contractor the overall plan, right? The architect is going to design the structure, coach the contractor on what walls need to go where, and then the contractor is just going to go do it, right?
Right. Yeah.
But sometimes they're just going to start throwing up walls if they're not coached properly in the wrong places.
Good illustration.
So
Yeah.
in your business, y'all grew extremely fast. You had a lot of great infrastructure in place, And all we were doing was essentially tweaking the couple things to get the cash flow in the right places. And then you were golden. It's not a tremendously huge exercise. It's just thinking through, is the business, the way that you're operating, paired correctly with the documentation that's in place, the accounts you have in place. And once that's done, I think you may agree, it feels there's less friction in your life. It
Once
actually
it's
feels like
good,
it's
yeah.
working the right way.
Yeah, big time. Like once it's good, like you don't have to give it any mental headspace, which is nice. Or your CPA emailing you questions that you don't know how to answer, which is always fun. This has been fantastic. There's more questions that I want to ask, but we're just about out of time. Um, the one thing I did like that you summarized quite nicely, like for a small business owner that might not have the money or it's not the best use of money to hire very good counsel that can help in terms of guidance, is just to make sure you're looking at a few things in terms of the tax election, where you're forming the entity. I like that one a lot because I learned a lot when you all went through that with me. And then also defining relationships inside of the company with any partners and such. The manager piece is very valuable. I think a lot of people wouldn't even know what a manager inside a LLC is. So that could be something we talk about next time as well. Like, what does that even mean, and what's the importance of it? Because a lot of times, like what we did was just file an LLC through the online form. It took 15 minutes. I'm like, all right, we're set up. We're set up. But that was it, which was not that smart. Like as I look back in time. But good stuff, my friend.
Yeah, there's so much we could talk about this, Steve, and I'm happy to come back again. There's like
Yeah.
some, traps we could talk about, why certain tax elections are made in certain circumstances, why certain control mechanisms are put in place, the pros and cons of forming entities in different states.
Yeah.
Um, so much we could touch on. But I think that your summary for a new business starting out, if you pay really close attention to where you're forming the entity, what type of entity you're forming, the election it makes, and then the relationships you're creating with the people that you're working with who are owning the business, etc. And then I think the last point is make sure you respect whatever you put in place
Yeah.
with the cash flow statements, with the bank accounts, etc. You do those things right, and we get to have a conversation when you hit this certain level of revenue, etc. There there may not be that much to clean up, or
Yeah.
at least what we're looking at was thoughtfully put in place where we can pivot into the newer and better things or couple things onto it. Because, like I said, an LLC is very flexible, where you will be in a great position in comparison to a lot of the people in the market if
Yeah.
those couple core principles are in place from the beginning.
Yeah, I'm with you on that. The big one to me is the relationship piece, just making sure that everything's defined up front. That's the big one, just because the biggest tax in business is when you have people problems or issues pop up that aren't, nothing's defined in terms of how it should be handled, and it turns out to be somewhat of a legal issue where now you have to do things right. Where it's defined up front, boy, does that make your life easier.
Yes.
Yes, it
Yes.
does.
Having a roadmap from the beginning
My
is
goodness.
a tremendous stress reliever when you actually get to that moment of conflict.
Correct. Don't just think it's all going to be okay from the get-go. I've made that mistake many times. But yeah. Anyway, this has been fantastic. Thank you so much for the wealth of knowledge and just dumping all of that on me. I'm gonna probably come back with a lot of questions, but next time we can definitely resume the conversation with a different topic. For everyone, if you'd like to contact Brock, we've got his email down below and their website, which a lot of information there. Feel free to reach out to him anytime. And as always, thanks so much for watching. Brock,
Thank you,
thank
Steve.
you. Thank you again, my friend. Talk to you
Appreciate it.
soon. Thank you.